Great. Well, good afternoon, everybody. Welcome after lunch to Is There Mojo in M&A panel. We've got a big panel. There's 5 people, so I won't introduce everyone now and assume that everyone's read the CVs of this great group of people. We've had some fun preparing for this, and we hope we have fun in the next hour or so. Secondly, we're a reasonably low-tech panel. We haven't got any quiz questions up front, or you don't need your phones. But the first question is there mojo in M&A? All the panel have got but there definitely is mojo in M&A. Unanimous support for that. So that's all you really need to know. Over the next hour or so, looking forward to this, but why can't I just spend a couple of minutes framing this for you? My name's Robert Rankin, or Rob. I'm the joint head of corporate banking securities at Deutsche Bank, based in London. If you actually look at M&A, particularly for us investment bankers, since the financial crisis, M&A's broadly flatlined as a product. There was a bit of an uptick after the cardiac arrest in 2009, but broadly since 2010 through 2013, M&A volumes have been broadly flat on a global basis. This year, even since the précis for this panel was put together, you've actually seen a very, very significant uptick in M&A volumes year to date. I think they're up about 60% year to date, which is a huge uptick, as you can see from this slide. If you then move to the next slide, which I think is 14, key question, is this sort of uptick sustainable? And what are the reasons for that? I can actually remember this slide, it'll come up in a second. But if you actually look at since 2000 as a percentage of equity market cap globally, M&A volumes have broadly averaged at about 6.8% of market cap each year. Basically, if you look at last year, it was around 5%. If you just do the simple maths, that would imply there'd be about $3.5 trillion of M&A this year. So we would put to you that we think that volume that we've seen in the last 4 months is really a mean reversion to the sort of percentage of equity market cap that you've seen in the last 15 or 20 years. Feels good for us M&A practitioners. There is lots of activity, and we'll cover a number of those sectors during the course of the discussion. So why don't we kick it off? Firstly, to Jonathan Koslett, who's a senior partner at TPG. He chairs their investment committee. To you, Jonathan. In the financing part of the business, your business, we're seeing covenant-light type loans, larger LBOs, which must be good for you. We're also seeing the strategics buying a bunch of assets off you. The equity markets are pretty constructive around also facilitating exits. How are you seeing M&A since the crisis for the financial sponsors? How are you at TPG differentiating yourself? And if you could touch on the financing piece and who you're selling your assets to, that'd be terrific. Welcome.
Thank you. So from the PE perspective, I think to frame it as you look at this chart on general M&A, across a long period of time, private equity has represented about 5% of total M&A. Now, of course, in 2007 and 2008, PE was about 20% of M&A. And in retrospect, many would say, and I think even I would say, that PE was outsized in its role in M&A in the last boom. Mm-hmm. And it'll be interesting to see what happens in this next era. But memories are pretty short. We're trying to have a longer memory at our firm, and I think many of our brethren in PE have a longer memory about how difficult the last cycle would be. So we're taking advantage of the environment, the very robust valuation environment, both in the public markets and in the M&A markets, and we're selling into it. We've been selling at a rate of 3 or 4 times the rate that we've been investing. Mm-hmm. And let's focus on the U.S. for just a minute. The U.S., it seems like we're in a longer cycle, maybe because it's been so moderate to get to where we are. So maybe we have a few more years of an upcycle. But I think on the PE side, we're going to be very focused on selling into strength. And perhaps you'll see more discipline on the buy side. That being said, financing markets are absurdly robust. All the things that lenders said they wouldn't do after 2007 and 8, they're doing again. Covenant lights, very high leverage levels, very loose terms. And that will fuel high prices and bad acquisitions on the PE side. And hopefully the better firms, the smarter firms, the ones who learned from the last cycle, will be a little bit more selective.
Okay. Geographically, US was broadly 55, 60% of PE volumes likely to continue?
I think we've all seen in this last rebound in the cycle just how resilient the U.S. economy is, the U.S. capital markets are, the U.S. transactional markets are, and I think we've all been reminded that whether it be parts of the Eurozone that have other structural issues that are not going away anytime soon and have got difficult demographics and difficult institutional issues, that's a harder place to do business and a harder place to make money. And then in the emerging markets, which are not monolithic, they're all very different, I think the bloom is off the rose. There are some really phenomenal opportunities in some places, and there's some areas where the structural challenges are, current account deficits or governmental issues are very challenging.
Why don't we move on to you, DA? DA is the Executive Vice President for Strategy at Sanofi. He's probably the top 5 most popular people at the conference, given what's going on at healthcare. He's heard lots of rumors about his own company. But healthcare, 80 odd billion of volume announced last week. Huge amount of publicity, huge amount of volume. Some of it inversion, tax-driven. What are the real key, both underlying and financial drivers for what you're seeing globally in particularly pharma?
Yeah. Thank you. It's an interesting question to hear you pose it in that way. When we first spoke about the panel, the question was, is there mojo in pharma M&A? Because we hadn't seen pharma being active. I think today, if anybody looking at the papers, it's clear it's the opposite, and it's clear that there is a lot of activity. So what has been the change? And I think the activity that we're seeing is really coming because, to your point, because of 3 reasons. The first one is around strategy, and there are good strategic reasons. And one can look at the activity and really divide it into 2. There's a piece that's around growth. So we continue to be an industry that is relatively unconsolidated. And so people are now, companies, whether it's a Novartis or a GSK or an Eli Lilly, that are looking at their portfolio of activity and saying, where are we lacking in scale, and exiting those areas, and then entering or reinforcing themselves in the areas where they have scale. So this first piece around growth strategy. There's then a second piece, which I would put more in the financial engineering bucket. And that's where we're seeing in things like the AstraZeneca-Pfizer deal, where it's really looking at things, to your point, like inversion trades, cash that's trapped overseas. And so it's less about growth and more in terms of what can we do from a financial perspective. The 2 other reasons, I think, why we're seeing this now move back into pharma M&A, one is tied to just a pendulum swing. Over the past few years, we've seen a shift away from big pharma doing deals. So if we go back about 10 years, 2/3 of the transactions in the life sciences space were done by big pharma. 5 years ago, it was 50%. In 2013, it was only 1/3. So we've seen this move away from big pharma, and now we're seeing big pharma, just with this pendulum going back, stepping back up in terms of activity. And the last reason is really around the environment. And there I'd point out 2 things. One that you alluded to is around the cost of capital and the fact that debt remains relatively cheap. And the second one is investors are still now seem more willing to support M&A activity than they have recently. So the combination of all of that really bringing activity back into the big pharma space.
DA, a company like Pfizer, which to me is a non-American but very pro-American and went to school here, to me is like the Coca-Cola of pharmaceuticals. What do you think about a company that genuinely putting up a proposal that may end up with them potentially re-domiciling to the UK? I mean, how does that feel to you as a
Frenchman?
As a Frenchman, or even some of the Americans. I mean, does it matter? Does it not matter?
I think the reality today is if we look at large companies, we've all become international corporations. If we look at Sanofi as an example, we may be a French company based in France, but we're really only doing about 8% of our revenues in France.
So domicile doesn't matter in that sense?
So domicile continues to be important, but people are more flexible. And definitely if one looks, I think, at the United States, there's less of a sense that one needs to be based out of here.
Yeah. Ray, it's always good to be up here with a competitor. I'm going to come back to you last. Is that okay?
Sure.
Sure. We're good friends, so it's all okay. But
I got my mojo somewhere.
So why don't we head up this end of the table, and we're going to talk about finance. Banking would be the exact opposite, certainly at a big cap end. I mean, you're seeing all this incredible activity in pharma. but due to regulatory constraints, the banks, I don't think there's been any big cap global transaction or big cap domestic transaction in the US for a number of years now. Stephen, you have been pretty active. You've done a number of deals. What are you seeing are the drivers of regional consolidation? Is regulation driving that? Are costs driving that? Take us through what's going on in the regional bank consolidation space.
Yeah, it's true that M&A activity within banks and financial services has been below expectations, I think, over the last couple of years. But there have been a number of what we found to be pretty compelling opportunities that you see emerging as trends in the space that I'd expect to continue. We at Banc of California have been looking at transactions where there may be some asymmetry of returns, and we have some good investors with Crescent Capital and Mark Adnacio and his team who've kind of helped us look at this. And what we find is that the regulatory conditions and the uncertainty that strives from it has locked up a lot of the larger bank transactions, and also the access to additional capital for distressed banks has locked up a lot of the distressed transactions. But what's come out of this regulatory process, which has been robust between Basel and Dodd-Frank and the CFPB, is a lot of reorganization of balance sheets and reorganization of businesses, where the larger banks tend to be looking to dispose of and sell of assets for oftentimes non-economic purposes. Mm-hmm. So most of the M&A activity we're seeing is buying from banks that have non-economic reasons for the sale, and we think that that's a nice pattern and position to be in. And just a couple examples of things that we've been seeing. One's within the residential lending space, where there's a lot of new regulations around consumer finance. There's a lot of volatility that's gone on in that space, from servicing and MSRs to other things. Our banks, from most of the money center banks, been very active acquiring residential lending portfolios. We've acquired over $1 billion of those. Mm. And it's really just a trade where, with the changing and uncertainty in the regulatory environment, the larger banks are looking to exit certain higher exposure fields. The other place that we've seen opportunity is when the larger banks are disposing of businesses or trying to pay down some of the capital that flowed into the system between TARP and SBLF. Last week we did a transaction with Banco Popular, which was a branch sale transaction for their California assets, where they have competing considerations that are less economic and more about paying back TARP, as they were the largest TARP debtor remaining. And so those are the opportunities that we think will continue. As you look forward to the next few years, we'd argue that you're likely to see a pretty big increase in M&A as the regulatory uncertainty starts to resolve itself. Most of the policy-making, decision-making is resolving itself and being implemented over the next couple of years. It's causing capital impact to the larger banks. It's causing regulatory and compliance impact. And you'll probably still see a lot of opportunity to acquire assets from these larger banks. And just since we're on, we've been talking also about, at least in preparation for this, yes, kind of the shadow banking system that's set up, which I think is also an increasing opportunity within banks, where over the last several years, with the uncertainty in lending and regulatory conditions for banks, there's been huge market share gained by non-bank lending organizations setting up kind of a shadow banking system between BDCs and other types of firms. What we'd see is, as regulatory certainty reemerges, I'd suggest that the market share will come back into the banks, and the banks will feel more comfortable knowing where they can play. And at the end of the day, the banking sector has the lowest cost of capital, and they're beginning once again to have a higher multiple on earnings and PE, which makes the home for a lot of these businesses back in the banking sector.
We might come back to that. Nick, moving to you. Thank you for providing us with our Mojo paddles. You're welcome. Your fellow panelists are very grateful for that. As the chairman and CEO of your company, you've been very, very active at American Realty and Capital, both in financial services. So, I mean, and you pointed this out to me in the preparation, you've been very active in financial services and real estate. incredibly active, including very, very recently, which you can touch on. Why don't you tell us what you've been up to, what's been driving that, but in particular in real estate, where affordability and low interest rates has driven the ability to pay some of the prices for these interest rates have been so low historically. Affordability has been at a high level for a number of years. If you could just touch on that financing piece, but more generally what you've been up to in financial services, real estate, why, what's driven it?
Sure. When you look at the overall marketplace, we do see that Basel III and Dodd-Frank has played a big role. And after the financial crisis of 08 and 09, there was a dearth of debt. So when you start to look at how do you structure deals, particularly in real estate, there have been a lot of companies that have been orphaned. Mm-hmm. They've over-raised capital at a very bad time. You saw companies trying to survive after 2009, raising, companies, big companies like Simon and Kimco, and they were raising money to starve off large debt maturities. Not so much Simon, but some of the other companies. And they raised a lot of capital. And there's arguments that in the real estate business, particularly the public REITs, that the yields have been relatively flat because when the RMZ was down 60%, capital was raised then, and therefore if you looked at cap rates today, the RMZ should be back to 2007 levels. They're not. They're still 300 points below, or about 25% where it was in 07. So what you see with interest rates is very simple. You've got spreads that are still close to 350 basis points on hard assets. These are capital intensive businesses, real estate, commodities, oil and gas, that are very boring, that have a lot of money. And if you turn to slide 8, you'll see that there's a lot of M&A that's gone on that is not in technology, it's not in media. You're looking at real boring businesses like real estate. You also look at financial institutions, which is another large, it's the teal blue line, energy and power, and consumer and retail. There's a lot of M&A that's been going on in very, very stable sectors. It's highly scalable, and there's good margins. Now, it's not the same as biopharm. It's not the same as tech. But at the same time, there's an aspect to it where it's highly scalable. So we've done, for example, our real estate business has done almost $40 billion of M&A between 2010 and 2011. And as recently as last week.
What's the biggest of those?
The biggest was about $11.5 billion, which was, we bought coal investments out of Phoenix. We bought Cap Lease off this exchange. We bought a number of non-traded REITs and rolled them into the traded space. But we did it with a shadow banking system. We raise a lot of capital, about $10 billion to $14 billion a year in the alternative space. So we raise it in the non-traded BDC, and which you mentioned, and the REIT space. In the BDC space, you were investing in right now we have about 140 portfolio companies that we invest anywhere from 20 to 100 million in, and we're seeing great scale there. But it's kind of a 12% total return model, which again, you can do over and over and over again. So I think lower yield expectations for the retail investor allows for a lot of capital flows, very stable returns, not a lot of risk. But it's not going to be the 25 IRRs that you see in some of the other sectors. As recently as today, we closed about an hour ago on a company here in El Segundo called Cetera, which was part of Lightyear, Don Marin's company, with about 200 billion of assets, and it was a $2 billion total transaction. And that is to expand our ability to distribute in the retail sector. So we look at it through our public FIG businesses called our RCAP. We look at it through AR Capital, and we look at it as almost everything in the durable sector. We stay actually the opposite of what we were talking about. So we're kind of the contrarians on the Mojo panel. But there's a lot of activity. And the funny part is, if you really look at the math, you could look at, for example, in the public REIT space, the grocery-anchored, power center, multi-tenant retail space where everybody understands it, not Simon, not malls. Yeah. There's 24 companies that have assets between $1.5 and $4 billion. That's probably 18 too many. So a dozen of them have to go away over the next 3 years. They're going to consolidate. There's too much G&A to run a $2.5 billion REIT. So there should be 8 $12 billion REITs, not 24 $3 billion REITs. And that's going to continue to move through because capital is plentiful.
Yep.
Debt is coming back, as you two guys know who are competitors. The debt markets are very, very active, and spreads will come in as interest rates rise. So we're expecting probably 100 basis point spread compression at the same time as interest rates will rise.
Thank you. Right to you, as head of Citi's Corporate Investment Bank, one of the global leaders in M&A, you see volumes from all over the world. We've touched primarily on domestic M&A so far. From your seat, how are you seeing global M&A volumes? How are you seeing the confidence in the boardroom to do cross-border transactions? What are you seeing, particularly from a global perspective?
From an M&A perspective, the globe is now defined primarily as North America and Western Europe. Let's take South Asia out of the equation as China goes through a transition and as India rebounds. And if you look to North Asia, the most active geography there is going to be Japan. And we've seen one large transaction, at least two large transactions come out of Japan. One, in fact, an inversion trade, which was the Applied Material where they're going to re-domicile. The other is the acquisition of Jim Beam by Suntory. Where are we from a boardroom perspective? If you go to slide 16, and slide 16 will be reflective of the phase in which we find ourselves. And we've gone through the following 4 phases. The first phase was post-crisis, a survival phase. The second phase was operational efficiencies. Corporations around the world were seeking operational efficiencies. The third phase, in the midst of central banks acting cohesively around the world, a mature reduction, not only the cost of debt capital, but a reduction in the overall total cost of capital. So there's a balance sheet repairing. And the fourth phase, which is the phase that we are now in, which is one that I think gets reflected here by the size and the range of transactions that are taking place, is what I'll call the strategy growth phase. What this chart reflects is, on the left-hand bottom side, you see the top 10 largest deals as a percent of the global volume. That was as of April the 23rd. If we include the transaction of AstraZeneca and Pfizer, to the extent that ever gets any traction, then that percentage is going to go up. So I think you're going to see more activity as a result of where we are in this phase. And this today is it's a factor of each of these corporations, either Comcast or Valiant or Holcim, and I'll come back to Valiant, Holcim, Lafarge, or Activist, Forest Labs, each of them now in a phase where the diet that is acceptable in boardrooms of increase in dividends and repurchase of stock as a matter of pure corporate finance returns has run its course. So we're at a phase now where we're looking for growth, we're looking for a return, and this is all part of the strategic mindset that we see more frequently and more confidently inside of boardrooms. A couple other catalysts that are aiding the thought process in the boardrooms. If we go to slide 17, we've talked around this, and now this gives you some sense of, there are 2 phenomena that are helping support boardrooms get a little more motivation behind taking action. One is what's taking place with the activists, either real or perceived. A part of the narrative inside of boardrooms is, how will we react if an activist surfaces? Have we done everything that we should have done? Have we looked at this portfolio in a way that an outsider would have looked at a portfolio, such that we need to take action before action is taken on us, whether or not we need to be proactive? So that dynamic today, you look at the number of activist campaigns. If you add now what's taking place with Valiant, you can see that number is now somewhere north of 140 or so. The other part is how the activists being funded. The number of investors, institutional investors, and other investors who are investing in the activists are looking at a chart like this, and they see the returns that the activists have been able to generate relative to the returns that other forms of investment have taken. And so activists as a form of an investment is becoming much more mainstream. It's part of the overall corporate boardroom landscape. Now, there's been some pushback, admittedly, from what's taking place from the Delaware courts. Having said that, if you look at the success rate and you look at the returns, the argument would therefore go that we think activists will be a fundamental part of the landscape for quite some time. It is yet to take place in any major way in Europe. This is primarily a North American phenomenon. Having said that, there are suggestions that funds will be developed, notwithstanding how open the system is apparently in Europe, funds will be developed across the continent such that the activists will become much more part of the narrative in Europe, similar to how they're acting in North America. We saw them in the early days in Japan. That has abated a bit, just given the overall Japanese infrastructure, but it's not certain whether or not they won't return at some point. So survival to efficiency, balance sheet management, strategy and growth, supported in many ways are facilitated by what's taking place with the activists, and then the inversion trades that people have talked about. Huge benefits without some kind of tax reform in this country, huge benefits to large multinationals redomiciling into more tax-friendly jurisdictions.
Thanks, Ray. Why don't we just stay on that activism theme for a minute? Jonathan, I think it's broadly about 100 billion that's now in activist-funded hedge funds. Many of those investors have been traditional funders of private equity as well. Through what sort of prism do you see what's going on in activism? I mean, normally activism's up when volatility is low, but that's offset by equity valuations also being relatively high now or have recovered. How do you think about that, activism through a PE prism?
Well, there's a search for return. There's a search for yield. And we're generally in lower growth markets and interest rates are low. And whether it be PE or activism, we're both sort of what I call fringe capital, trying to find ways to find those niche opportunities that aren't the mainstream, middle line, S&P 500, 13% CAGR. And I think it's great. More transparency. I love free markets, I love democracy, so if an activist comes out and says you have too much cash or you have non-core divisions that don't make any sense and or you have management that's not doing the right things for shareholders, I think it's a great thing. And over time, a lot of the low-hanging fruit has now been picked. There's still a lot of companies with a lot of excess cash, earning 0 or 1%. And by the way, one of the reasons why there's so much M&A is that anything that acquirers are doing is accretive, given how much cash they have and how low their yields are. So it's kind of an interesting phenomenon in M&A generally, that for the history of all of our careers, when an acquirer made an acquisition, I don't know what the exact stats are, Ray, you know them, probably 2/3 of the time the acquirer's stock went down.
Yes.
Now, again, Ray will know the stats, 2/3 of the time the acquirer stocks are going up because it's accretive. But anyway, I think activism is a normal part of increasing information flow, transparency, freer capital markets. And the key question will be, now that the low-hanging fruit has been picked, what's the next gig for successful activists?
Can I?
Yeah, please.
We've done this year so far, as I said, like $20 billion of activism and mergers, and they're always tied. So when you start to trade on the fact that you're willing to move forward in a transaction, our board looks at, I'm on 9 different public company boards that we're involved in, and in every one of them, the first conversation that comes up is coming from the activists. It's not a conversation that you may have.
About the activist, or the activist is already?
The activists are putting the questions to the board.
Yeah.
It's not a question you may have. It's a question you will have. The board will address, the board will have to address activist questions such as, should you spin off some of the assets you bought? Should you spin off some of the assets you already own? What is the best way? Even in REITs, which is a boring business, the new concept of having an asset management business which is a much higher growth business and trades at a much higher multiple versus having that management team embedded in your operating business if you're growing. Should you spin off some of do tax-free spins on your asset classes if you have multiple asset classes? Would a net lease company or an office REIT trade better? So would you split them? And that conversation is, I would say we hear it twice a quarter per company. It's now part of the jargon. So I think all of us on the public side have to realize it. And when you look at it as an acquirer, the fact that public companies are now willing to make hostile bids, even though, as you bankers know, that was not something you would do 5 years ago, 10 years ago, you would never do it because you'd be outcast. But today, you can make an offer. You can come right over the wall, put a bear hug on a company, and as long as you're willing to go the distance and you're willing to do it, those kind of transactions are real. And that makes everybody else think twice, particularly when it starts. The industry then starts to pervade that concept. So activism, I think, is a good thing. It does make us sharper as a public company. It makes the seller start to think about, well, if I don't talk about this, you know, Maryland law for REITs and Maryland law in general is very, very company friendly. And most people think, and if you look at what Sam Zell did with Corvex and Related most recently, that was a deal that they should have never won. But they got enough people together with Corvex, with Related, and then bringing Sam in, you got the index funds to vote with them, and you broke up a deal under Maryland law, which was easy to do mathematically, very difficult to do legally, and it got done. So that changes the rules. And changing the rules isn't a bad thing, particularly when it benefits the shareholder. So I'm on the side both as an owner and a non-seller and a buyer and somebody who wants to force a transaction. I think it's good from both sides, and it does change the complexity of the world where a company just can't say no. They can't just ignore you.
Just before we move off activism, DA, as a traditional European corporate, how do you think about that?
In terms of activism?
Yeah.
I think if you look at activism and their success rate, particularly in our sector, you see both sides of the equation. So sometimes it's actually led to value creation. At others, it hasn't. So it tends to be relatively target specific. The one thing it has done, and in one way in which you could say perhaps larger pharma has benefited, is that it's led to a number of the smaller companies being sold. So you could say, has that been good overall for the industry? Again, that can be debated. There is value to having a whole class of mid-cap companies that evolve into the next generation of large-cap companies, but clearly it has been able to generate value for some sharebholders.
Staying with what's taking place in large pharma, I think large pharma and boards of large pharma have been proactive in restructuring their portfolios.
That's true.
Independent of activism. I start with Merck. If I look at Merck, I look at GSK, I look at Pfizer, I look at how you all have paired your portfolio. In terms of shareholder returns, large pharma has been proactive and leading in many of the initiatives of restructuring themselves. Sure. Now, in large part because they were going to hit a patent cliff, and as a result of it, the market demanded that they had to restructure. But I think as an example, large pharma has been out front.
Any comment on this statement?
Activism's a tricky game in more regulated businesses like the banks. So it's a little bit harder to take with a generic statement. That said, I think that some of the issues around spin-off of assets and recomposition of the portfolio and some of the things that Nick was talking about are equally relevant to some of the larger banks.
I'd like to segue to financing, if we can, for a minute. Jonathan, so LBO size is going up, still not back to where they were. What's the biggest type LBO that you could envisage being, in a traditional sense, being done in the US in the next couple of years? Or just talk about the financing constraints around that, whether it be on the equity or debt, club deals.
I'm not sure that that LBO size is going up.
Okay.
What I mean by that is, of course, there's going to be larger transactions, but the era of the mega deal that we saw in 2007 and 2008, there's a lot of carnage from that. And I think a lot of folks learned the challenges of doing super large transactions. They tend to be pro-cyclical. That is, they're for sale at the peaks of the market. They tend to be hard to move because they're lower growth and it's hard to change them. They tend to be hard when they get in trouble because the amount of capital it takes to get through them is just so enormous. So while there are more transactions that are $5 billion and $7 billion and $9 billion and $10 billion, I think it's going to be a lot less robust on the mega deal side than you're implying, just because I think there's still a lot of lessons learned from 2007, 2008. That being said, from a financing perspective, I think the amount of capital available is not a constraint. Yes. It's the equity discipline around whether you want to make that transaction. You know, we just agreed to sell Biomet to Zimmer. There's going to be, you know, $10 billion of financing. That's no problem. Mm-hmm. So the financing is not the issue. Mm-hmm. It's the equity discipline of should we make that transaction. And I hope you will see far fewer large deals this time around than last time around, because many of them were ill-conceived.
And that equity discipline goes to clubbing with the club type component to equity, which...
I think that part of the market is also gone.
I agree.
What I mean by that is when we all did the very large transactions, even with relatively large fund sizes, the deals were so big that you had to team up with other peers to get that equity together. Today, that's sort of not particularly well perceived by our limited partners. And while we might work with limited partners who want to invest directly into deals, the number of times and the number of partners that you see coming together to do deals is much smaller, much fewer, because we all have understood that what our limited partners want is individual differentiated stories from TPG and KKR and Apollo and Blackstone. They don't want a transaction that has all of us in together. That's not differentiating for them.
Right, so Jonathan touched on the fact that financing is not a constraint. In the public markets, we've got concerns about confidentiality. We've each had to sit there and look at big underwritings pre-announcement on a sole or joint basis. How are you thinking about that?
I would edit that a little bit. I think the world has shifted now from a financing standpoint. The large money market banks are under a different regulatory regime today than they were from the period of the fourth quarter of 2003 till June of 2007, where you could lend up to your legal lending limit on a straight basis, and then you have a couple more percentages for working capital. Yeah. Today, given how you have to rate many of these non-investment grade loans, the impact it has on the Basel ratios or the impact it has on the supplemental leverage ratios puts some constraint for the large money market banks, at least the North American money market banks. And then that then creates the dynamic that we're going to refer to as outside of North America, who do you see leading outside of America? Because there are some Canadian banks that have adopted the rules differently, and there's some European banks that have adopted the rules differently who have played more aggressively. So it is the source of financing, the size and the source of financing, and yes, there is the advent of what we call the shadow banking system. Well, in the heyday of the leveraged buyout market, we had shadow banking system. The shadow banking system then was called GE, CIT, and the insurance companies. Today we call them something different, and it's primarily in the mezzanine fund and at a much smaller size. They exist, but the source of financing today is going to be different, which is why, as Jim pointed out, notwithstanding the return criteria, which make it very difficult for these large LBOs, the financing sources have changed now.
Nick, you've been innovating in the financing. How are you thinking about financing from a size perspective, constraints perspective, how it's driving affordability?
Well, I mean, look, there's really three different ways. If you're an investment grade borrower, you're doing it at one level, and you guys can do a better job explaining that than I can. But I mean, if you're borrowing as an investment grade borrower, you're probably paying 4%, 3.5% for money, or less. If you're looking in the first lien, second lien market, and you do a kind of a leveraged structure, the money is more reliable. Mm-hmm. You can definitely get it. It's going to go to the BDCs and the venture and the private equity guys, and they just line up for the money. But it's going to cost you $900 over. The second lien is going to be $900. The first lien is going to be $500, and you're probably going to pay 2 points in fees, and you're going to get the deal done. But you got to have yield. So you get it degrades very rapidly, which is why I think one of the things we're not talking about, which is who's the buyer. Yeah. If the buyer is a public, If it's a strategic public buyer or a strategic company, whether it's private equity or public, and it's a strategic transaction, the deal, it looks very, very different than just an LBO. An LBO is not so easy to get done today. A conventional LBO is almost impossible to get done. But if it's sponsored by Comcast, well, now we have a whole different conversation. And I think you're seeing corporate players play in this market differently. If you look at the landscape in 2006 and you look at the landscape today, the Cetera deal that closed today had first lien and second lien money. It was easy to raise. It came in real fast. They were right there and ready to go, and it was very reliable. But it cost probably $650 over to get it all done. So you had to have something that's throwing off a current coupon of kind of 8.5. Yeah. And that's not so easy some days when you're buying some of these more sophisticated. It's great for core business, correct, right? It's great for railroad. It's great for oil and gas. It's great for real estate. It's great for commodities. It's not so great if you're buying a technology company because you don't have the cash flow. So cash flow loans are back. As you said, banks aren't doing them. It's BDCs. It's public BDCs. It's non-traded. Take the non-traded space, for example. 3 years ago, we raised $200 million in BDCs. Last year we raised $4.5 billion. This year we're going to raise $9 billion. Our BDC alone raises almost $250 million a month that we're putting out on a levered basis, 1-to-1, and both of your banks are doing a repo line for our BDCs. So it's easy to get it when you have a $1 billion balance sheet. Yep. Not so easy if you're trying to do an LBO. It's true. So I think we have to really dissect this whole business really into three classes. One is the kind of the LBO business, two is the strategic buyers, and then the third is the private equity business, and private equity plays an incredibly important role that wasn't recognized, I think, 5 years ago. Private equity today, the Dell deal is a good example. The deal that Ackman just did on the BioPharm deal, those kind of transactions would not have happened without private equity. They were not going to be done by, IBM wasn't going to buy Dell. They weren't going to fund a go private for Dell. So when you really think about it, BlackBerry, how does that deal get done if it ever gets done? How do you do some of these transactions? So I think that we have to look at where everybody plays, and I think there's becoming more defined roles for private equity, for the strategic publics, and for the whole growth story. And then I think the last thing you're going to see is you are going to see activists. I'm going back to the activists again, but you are going to see the activist bent coming into these transactions where you take down a big portfolio and you break it up, and the strategic keeps what it wants and it sells to private equity or somebody else the rest of it. And they use the leverage loan market, they use the BDCs who have tons of capital to fund that on a moderate term basis, 5-year, 4-year. And it's going to cost them warrants, it's going to cost them costs, but it's still cheaper money than having to raise equity.
Yep. So picking up that who's the buyer theme. So you've talked about the strategic, you've talked about the financial type buyer. Jonathan, I mean, you guys sell a lot of portfolio type companies. How active are you seeing emerging market buyers into the US? Are they really relevant? Not that relevant? What do you make of that?
I think there's increasing global players looking, emerging markets global players looking. Yeah. Their willingness and ability to actually transact is still very low. Is it courage? Is it finance? I think it's not feeling welcome. It's structural issues. It's cultural issues. It's management. There's a lot of looking around. Yeah. And then a lot of walking away at the end for no particular reason. It's not whether the price is 95 or 105 or 100. It's just we just can't get there. Again, Ray knows the stats on how many times a Chinese or Indian or Indonesian company has actually completed a meaningful size transaction in the U.S., but it's a low number.
I would query, from a political standpoint, whether or not you would see any acquisition of any magnitude by a geography that is not Western Europe or Japan into North America. The largest transaction that we've seen in the history of these transactions was the acquisition by CNOOC into Nexen into Canada. And remember, when BHP tried to go after the potash, there was a let's call it a structural reaction that came from one of the provinces in Canada. And what is a
BHP is not that exotic.
That's right. And notwithstanding the openness and how global we are, I'd query whether or not there's been some geographic balkanization when it comes to regulation.
I agree.
And how that's evolving. So to Jonathan's point, I would.
I agree with you.
It's a big question as to whether or not you would ever see a large transaction that we would look at and say, and Washington would look at and say, we're going to welcome this kind of investment, any wholesale investment into this country.
Would you agree that that's irrelevant of accretion?
Pardon?
Would you agree it's even irrelevant to the accretion of the transaction?
Independent of the economics. Yeah. I would assume that most of the economics, well, I would assume that it depends on your definition of emerging markets. But remember, while we have a low cost of capital, many of those geographies have a negative cost of capital, right?
Yeah.
So independent of the return criteria, this is a matter of,
Ray, and you're not,
and I'm unexpert at this, so let me qualify myself as a practitioner in advising these corporations and boards. It's a challenge to get one of these transactions done.
I agree.
Unless everything aligns.
and you're not differentiating too much.
I'm sorry, I was going to say, do you think it's going to be sector specific?
That's relevant.
Well,
It's something like Lenovo, right? So Lenovo acquires
But just Lenovo, but look at the size of Lenovo. Lenovo acquired IBM 10 years ago in less than $2 billion transaction.
And you got Smithfield in Piggeries, but really small.
Right.
Going to Ray's point.
You saw but remember, that's you've not seen the Japanese come into North America in any large way. You saw them buy sector specific. You saw them by the theaters. So you saw Dalian Wanda buy the AMC theater business. That didn't hit much of our screen. I don't think that we go in and sit in the theater somewhere in Century City that we're saying that we're sitting in a Chinese-owned theater. I think we're independent of that experience. Japanese Suntory buying Jim Beam, large acquisition that didn't hit a lot of headlines, an important acquisition for the Japanese as an expression of the support on Abe economics. Wasn't strategic enough of an asset for the U.S. It may be for some of those who are big partakers of Jim Beam, but I think from the standpoint of U.S. policy, it had less. That was my mojo move. It had less of an impact.
Yeah. Why do we? I'm going to start to open it up. We've got about 10 minutes to go for questions, so if people can start to think about that, we can keep talking. But I certainly want to give the audience a chance to, in the last 10 minutes, if there's any questions out there. Is there someone?
She's one right there.
Oh, great, please. We can't, it's difficult for us to see you. We can certainly hear you, I think, but.
Sorry. They can't see either.
Hi. When you look at some of the accounting behind some of these recent M&A deals, you see a lot of, when you look at it, you see a lot of goodwill, you see a lot of intangible assets that basically add up to often more than the announced price of the deal. If you were to reverse course from an investor, like an everyday investor's point of view, does that concern anyone up there at all? So you see, let's say, a $2 billion deal, and you know, the intangibles plus the goodwill exceeds that amount.
So when the investment committee at TPG, Jonathan?
Not really, in the sense that companies are generally valued based on their earnings, their real earnings, whether it be cash earnings, true cash flow, and the artifacts of old goodwill that was created as the company grew, that really doesn't factor in. And most analysts are now looking at earnings per share on what they call a cash earnings per share basis to remove the distortion of goodwill and the non-cash items.
Any other comments?
Yeah, in our business, in the real estate side, we actually look for deals that have the inversion. It wouldn't scare us to do a deal that it was heavy in goodwill. Obviously, you'd never be more than 25 or 30% in a real estate transaction because you may be buying appreciated assets or you may be buying depreciated assets that have not really depreciated from a tax standpoint. But it is nice in real estate, particularly to buy properties that have a high tax basis, and structuring around that is, in many cases, the idea of buying the assets rather than buying the company. So you get a step up and you get to redepreciate them, because part of the value of being a REIT is having pass-through depreciation to your investor and tax deferral to that income through the REIT law. And so it is something we look at when we do an M&A transaction, so that we get the benefit. Once in a while you have no choice and it's a roll-up and you can't do it, but you always want to rebook those assets to par so you can pay the cash flow out better and have the tax deferral.
Well, one little fun historical comment, because we're at the Milken Conference. I started my career 27 years ago working for Drexel and Mike Milken here in Los Angeles. And as a young guy, what was fueling the boom in LBOs in the mid-'80s was we came up with EBITDA. We came up with the construct of earnings before interest, taxes, and depreciation and amortization, because everyone prior to that was only looking at the bottom line number, regardless of how much was non-cash, regardless of how much interest expense, regardless of tax rate. And we sort of came up with this, and really Mike came up with this interesting thing of, that's all irrelevant. What's the cash flow of the business? And that was, 30 years ago, right here in Los Angeles.
That's cool.
Within the banking business, it's extremely important, and it may be that the bank regulatory regime hasn't caught up to EBITDA, where goodwill comes straight out of your capital, and therefore you have to replace that with the deal. And it's been one of the most significant impediments to M&A activity in banking, because banks have a structural benefit of holding assets that are held for investment at par. But when you buy a bank, you have to mark every loan in the portfolio to market value. And what that means is that a bank that could be profitable and have loans that work given the low cost of capital, when you start looking at what those loans would trade for at fair market value, goodwill can become very significant. And it means that you're often doubling the price you're really paying for a transaction. So you have to think about that. In our situation, just to give you an example, the most recent transaction we did is really only consideration for $1 billion of assets and deposits of about $5 million. It's the regulatory capital that you post that supports the earning assets that is the biggest part of the E and the number of shares outstanding. And every dollar of goodwill means that you have to add another dollar of regulatory capital, and so it's an enormous issue.
I guess I was thinking more like WhatsApp. You have a deal like WhatsApp,
Just depends what its earnings power is, and not only on its own, but what its earnings power is as owned by Facebook.
Any other questions out there? Please help us, because it's a little bit hard to see. Sure, sir.
Yeah, I keep thinking when I hear you gentlemen speaking about all the assets that's available, yet when you look around the communities and you see the deterioration of the communities and you see the people that have no education, you see all these assets available, and yet what is being spent to make those profitable. It bothers me so much. I hear so much talk about money, but I don't hear anything talk about the human quality and how do we get that quality operating with the young people that's going to be coming up in the future. It seemed like to me that it would be an effort on all the companies to get involved in creating the kind of assets that's necessary to make these young people realize that there is a future. You have gang kids running the street, shooting, killing, maiming, and yet they have no hope. They think they won't live to be 25 years of age. How do you change that? Why don't they think that they can have the kind of asset? The money you're talking about is so huge, it doesn't seem possible. How do you get those young people to think like that? You have great minds, and yet these kids have no education. They have no schools. They care about them. A lot of them came from slavery or other ways. How do you change that? I mean, where's your heart? You understand?
I think we agree. I think I agree, and I'm sure everyone here agrees with that sentiment. We all have social responsibility. Our companies have social responsibility that we need to fulfill. And we also need to be the capital that helps new educational approaches develop, whether they be technology or infrastructure. And I think that's all of our responsibilities, is to make sure that, particularly for us who are Americans here in the United States, to make sure that this immense amount of wealth that's been created by the business system makes its way to the places that need it most. I think we all agree with that.
Yeah, let me, I can't see your name, but I think you may be, it starts with Rosie, and there are not many people who,
Rosie.
Is your last name?
Greer.
There, this is the great Rosie Greer. All of us, at least I stand on your shoulders for the leadership that you took. Yeah. So thank you. What you've identified when you talk about assets is the most important asset that we have as a country. It's been alluded to in other panels. You're describing the human asset, and whether or not the structural deficit that exists in some of the neighborhoods and some of the communities is being addressed by a community like this. The sentiment is there, the heart is there for the most part, and the people with whom I interact on a fairly regular basis. There are initiatives that are taking place. There are people who have made billions, who are spending billions to attempt to address what is a structural deficit in this country. We're in the early stages. The deficit grows while we try to come up with ways to mitigate. But you should recognize that there's attention being paid, there are efforts being made. They're not large enough yet, and I don't think they got enough traction yet, but there's attention being paid to it. You're right to point it out. We have a responsibility, those of us who have come from the neighborhood, have a responsibility to address those. As you know, those who've come up the rough side of the mountain have responsibility to make sure it never reach back. And so each of us recognizes that as a responsibility in our own ways. I think you will recognize if you go through and look at how we spend our time when we're not doing this and advising on these large, what are significant size transactions, you'll see that much of our heart and time and resources is spent trying to address what you've outlined.
Now, yeah, I just wanted to make a quick comment. First of all, thank you for what you said. And my whole business career and the business that we run at Realty Capital Securities is all about bringing retail investors the same quality of assets that the institutional investors get. And we believe that this is the first 5-year period where the American middle class, which is the aspirational class from the people that you're referring to who have not got the education. And today the middle class is defined as somebody that has $1 million of total assets, which could be a school teacher, and it could be a farmer, and it could be a lot of people, because $1 million isn't what it used to be, including a home and all your retirement accounts and your insurance policies. But when you look at it, they've been void of getting access to the type of products we've been dealing with. And one of the focuses of our business is that 7.5 million mass affluent American families that have not got access to a Blackstone or a KKR or any of these other funds. And part of giving back is not just employing a lot of people, which we all do, but part of giving back is making sure that the products and the financial services that we all create are available to everybody. And in our company, it's about training and education. It's about bringing this to the retail advisors. Most of our financial advisors meet with their clients in a Denny's or in their home, and they don't do it online. They don't do it by email, because a lot of people don't have email, and a lot of people don't, particularly the aging population of America. This is the first time, think about it for a second, not just the young, but it's the first time in America where it's a growing population of people over 85 years old. It's the first year ever in the history of the world that there's more 85-year-olds than there were 84-year-olds. And that's something we have to think about. We're living longer. We need more help. That's healthcare. That's everything. So our view, I guess, is that giving back starts at all levels: education, charities, giving back to others, domestically and foreign. And then it also comes back to making sure that what we all do is available to everybody, whether that's through an online service or through low-level retail advice or bank branches, which Citibank and Deutsche Bank, they all do, and not just selling them some packaged product. So I think there's a way we can help. We're not doing enough, and we'll probably never be able to do enough, but somebody has to start, somebody has to try, and I think it's our obligation to do that, so thank you.
Rosie, thank you for your question. I think the social responsibility aspect's being dealt with. As a friend of the United States and a close friend but a non-American, I would say one of the great strengths of your country has been around the vibrancy of the venture capital market, the vibrancy of the financing markets in the non-investment grade area, which have enabled job creation over time. As I travel the world, I think that one of the single biggest problems to global stability is actually youth unemployment. And I think one of the great strengths of your country is the ability to have this vibrancy of capital for great companies to grow, to create jobs, and it's really good quality jobs over time that we're really looking for the people that you've talked about. So thank you for your question and contribution and rebalancing this whole conversation. So thank you very much. I think we're, on that note, we're done. So thank you very much for everyone to coming to this conversation. We've got thanks for all the panelists.